Hey everybody, and welcome to a new video where we're talking about the volume profile, and specifically we're talking about time frame. Now in this video, I want to jump into my charts. We're going to be saying just some general points about time frame, but I want to pull up and I want to show you what time frames I am using, why they're important, and I really hope that this video will give you some inspiration on what to use when you're profiling, and also how to just set up your charts in general. So let's go ahead and jump right into it. Okay, before we jump into my charts, I need to say this up front, that I'm using time frame so liberally in this video. I understand, and you understand, that your charting package can set up a variety of period types. You can have it set up based on volume. So every time 500 volume happens, that a new bar gets printed. You can have it set up on time, which more accurately would be time frame, where every 3 minutes or 15 minutes or hour, whatever you decide, every time that time passes, it prints you off a new bar. You can have it set up where it's range. Every time it travels a certain amount of distance, a new bar gets printed. So we understand that there's a lot of these period types we have access to. And in my own personal trading, I use multiple different period types. But in this video specifically, when I say time frame, I'm just referring to all the period types just to keep it simple. And just so you don't have to jump in the chat box, jump into the comments and let me know that it's not actually a time frame. I get it. With that being said, let's go ahead and start off by talking about a few points here about time frame. Okay, so in your trading and in your analysis, it's going to be very important that you have access to more than one time frame. If you're trading even one product and you're only using one time frame, you are missing out on a lot of information. You're missing out on a lot of functionality, and you're doing your trading a huge disservice. Now, the way that I see it is you need time frames for different tasks. You need a time frame that you see the picture. This is where you're going to be zoomed out and get the context and really get the narration on what your product is doing. You're going to want a different time frame to drill in and to see what I just call the pattern. Now, when I say pattern, I don't specifically mean like head and shoulders or double bottoms, but everybody, all of us as traders, we are looking for repeatable patterns to happen in the market. And there needs to be a time frame where you find your setup. So we have something where we're looking for the context, we're seeing the picture. We have a time frame where we're looking for the pattern, and then we need an additional time frame where we are going to pull the trigger. Now, I want to jump into my charts and I want to just look at these in a little bit more detail, and I want to show you what time frames I'm using to see the picture, to look for the pattern, and to pull the trigger. Let's switch over to the charts and we'll get started with that. All right, now when it comes to time frame, especially when we're looking at the picture and we're trying to just get the story and look for the context of what our product is doing, the highest time frames we have out is how we're going to look for the picture. Now, in my case, the way that I do this is with two time frames. I look at the weekly as well as the daily. Okay, so pulling up the weekly first, what we're looking at right here is a chart where every profile is set up to be a full week. A full week being the 5 business days, so Monday through Friday. These candles are also weekly candles, so it's a full week at a time. And what I can see here is a very zoomed out view, and there's certain pieces of information that I want to pick up on. On a weekly time frame, are we one time framing up? Are we one time framing down? Are we holding range? Where is that weekly point of control and value area shifting to? This and multiple things are very important to my analysis. We draw this out on a weekly time frame. Now, drilling it in a little bit closer, I'll also use a daily time frame. Now, this is a very similar thing to what I'm seeing on a weekly. It's just a little bit more refined and a little bit more granular. When I'm using the daily time frame, this is also where I'll draw my composite profiles. I don't draw those on the weekly. I'll draw that here on this daily time frame chart. The individual profiles here are still going to be weekly. So these candles are a 1-day session. The profiles are going to be full weeks, so those 5 days included. And I'll have a different time frame where I look at the intraday profile a little bit more specifically. But this is where I'm going to draw my composites and pay very close attention to the high and low volume nodes, as well as just the information that this profile is telling us. It'll be very important. Okay, so when it comes to looking at the picture and getting context at what is happening with this product, the way that I do this is with the weekly and the daily. Those time frames are what I'm using to draw out these profiles. Now, when I'm drilling this in and looking at this day to day, when I want to look for the pattern and come up with a trade idea and actually see what's happening here and what is setting up for me, the way that I do this is with a 15-minute as well as a 30-minute time frame. So this right here is a 30-minute time frame. Each one of these bars represent a 30-minute period of time. And when it comes to a product like the S&P 500, the 30-minute time frame is very powerful. Okay, the information on the actual profile is going to be the same because we're looking at an intraday here, but the time frame of these 30-minute chunks is awesome. This is originally how the market profile used to section out the displaying feature, and even though I don't use the market profile, that 30 minutes is still extremely powerful. In this one example here, you can just see in this is the overnight session, this is the day session here. And you can see that just what's happening with that 30-minute is important. So as we're stair-stepping down, you can see this 30-minute was just going these lower highs the entire way down, mostly lower lows. And if that is one time framing down on a 30-minute time frame, you had better be very careful fading that or fighting it. And you can see here, once that one time framing down ended, we changed directions. And then through the rest of this session, we started one time framing the other way. On this way down or on this way up, if you found yourself trying to fight that action, you were probably punished because this covered a lot of range. So just as a simple example with what happened in the most recent session, the 30-minute time frame on the S&P is very nice to be able to zoom out of the action and just see how that day is really shaping up. It's very important to my analysis. And then I'll use the 15-minute with a very similar task, just a different, more refined view. When I'm looking at understanding what is developing, I look at this 30-minute chart, and this allows me to see it. So an example of going back to 2 days ago, this would have been last Thursday's session, when we had this double distribution day form. The way that I was able to pin this out and to see this developing was on this 15-minute chart. Even before the point of control and value and everything shifted down, back when the point of control was up here on the day, being able to see and kind of zoom out from the noise and understand that distribution had formed up there, there was the developing point of control, the shift down was likely, and that double distribution day was on deck. Being able to trade off of that as well as just put it together that was forming, that comes from seeing it on the 15-minute. And this is what I'm talking about when we say a time frame to look for the pattern. This is how I can come up with high quality trade ideas. Most of that happens on the 15 or the 30-minute time frame. And really, once I've done these steps, once I've looked at my charts to put together a context and to get the story of what the market is doing, and when I'm able to drill that in and to see high quality trade ideas or to put together a trade idea based on something a little bit more zoomed out like the 15 or the 30-minute, I then am in a position and I use time frames to drill in even closer, and this is how I pull the trigger. Now, to pull the trigger, I'm going to be using the 3-minute and a time frame that is not range based. Now, the 3-minute chart is something preferential. I find it just a nice way to view what is happening. And I use micro composites built on the information that's happening on this 3-minute. I also do it with my trigger chart, but this information does not come from just the daily profile. This is not typically, sometimes it is, but it doesn't always have to be multiple days put together. But these micro composites that I have built out, the one you're seeing right now is in fact bringing in multiple days, but it is based on how things shape up on this 3-minute time frame. This is an important time frame, just kind of preferential, but this is a beautiful way for me to draw out some micro composites that are very important. To give you an example of this micro composite, the market was just absolutely going crazy. And being able to take back this micro composite's value area, okay, kind of ignoring this profile here, just looking at this micro composite, this value area low. When we failed out of this, we went down so far, we came all the way back and took back this value area to target the point of control for this micro composite. It was on deck. It was something that was likely. It's what I was looking for. That information comes to me from this micro composite drawn on the 3-minute. The other one I'll use is a range-based chart. that on the S&P is set to 6 ticks. Right now, that's extremely volatile, but I'm just leaving it the way that it is. And what this means is that every time we pass 6 ticks, so if we go down a point and a half, anything over that, 7, 8, 10, whatever, it plots a new bar. And so if you'll notice, these little numbers are just displaying the size of rotations. And there's nothing less than 1.75, which would be those 7 ticks. Okay, because that's, if it's rotating 6 ticks or less, it's not going to plot a new bar for me, regardless of how long it takes. And then this is the other time frame that I'll use when I'm looking to pull the trigger. Now, if you've gone through this process, or if you have a similar process where you can see what's happening in the picture sense of it, and you can identify a pattern and see a high quality setup, then by using, in some cases, very basic or even better, advanced technique, you can drill in with these smaller time frames and really refine your entry. And what comes from this is you have the ability to really increase your win percentage. You have the ability to increase or drastically decrease the amount of risk that you take on trades as they're working out. And there's a lot we can do with this, with just even our overall win rate when you're drilling in and you have a time frame that you're using to pull the trigger. And as you can see with all these examples, these are drastically different time frames, which displays the information very differently. But these are all very important. Now, I know in this video, we've crunched through a lot of information very quickly, and I was kind of just speed burning and running through this. But multiple time frame analysis is a must. And to keep things very simple, to have a time frame or frames where you get the picture, and to have time frames where you're looking at the pattern, and to have time frames where you're pulling the trigger has been a very effective thing for me. And I know that if you don't do it exactly like me, and even for different products, I'll have this set up a little differently. But the idea here of having that process in place is very powerful, and it's going to play a really big role in improving your analysis as well as your overall trading. So I hope this video that I kind of just crunched through provided you with some inspiration and just some ideas for how to set up your own charting, as well as the time frames that you should be using, and maybe broadening your horizons if you've been focusing in a little bit too narrow on the time frames that you're using to incorporate information. Now, if I had to boil it down to the most important time frame for the volume profile, or the most important time frame, I would boil that down to the 30-minute. I think the 30-minute is a really, really great. I don't make trade decisions based on it. I need to drill in closer. But as far as zooming away from the noise, in terms of a lot of different types of market volatility, the 30-minute is just rock solid. There's times where the trigger chart, it's just too volatile, it's too noisy to really be able to read what's going on there. And then there's times where if you zoom out too much, the volatility is not enough to where you can really put a story together. But the 30-minute, as a general sense, is just it's a really, really great time frame. All right, I'd be interested to know in the comments if you had to only pick one time frame, or what are the most important time frames to you? Understanding that I'm still saying time frame in a very general sense, and I'm just referring to period types. Okay, so that's gonna be it for this video. You can let me know that in the comments before we head out. And also, we can all hit the like button on the way out. And if you're going to be on the screens between now and the next time I see you, I wish you a very happy trading, and I'll see you guys in the next video.